Right now, as you're watching this, something terrifying is quietly happening inside the American banking system. Customers are walking up to their own bank branches, trying to take out their own money, and being told no, not because the money isn't there, not because of a fraud alert, but because the banks themselves have decided that you don't get to decide what happens with your own cash anymore. This is not a conspiracy theory. This is not some fringe internet rumor. This is happening right now in real time across the United States, and the mainstream media is barely saying a word about it. Stay with me for the next few minutes because what I'm about to share with you could literally change how you protect your family's financial future. And if you've ever trusted a bank with your life savings, you need to hear every single word of this. Before we go any further, if this is your first time here, please hit that subscribe button right now and give this video a like. We cover the financial stories that the mainstream press doesn't want to talk about, and we do it before it's too late for you to act. So subscribe, hit the bell, and let's get into this. Let's start with what's actually happening on the ground. Across the country, ordinary Americans, people just like you, are reporting that when they try to withdraw large sums of cash from their own bank accounts, they are being interrogated, delayed, and in some cases, outright refused. We're not talking about people trying to rob the bank. We're talking about retirees who want to access their own retirement savings. We're talking about small business owners who need cash on hand for payroll. We're talking about regular families who are simply scared about the economy and want to hold their own money in their own hands. And the banks are saying no. Or worse, they're saying, we need to know why you want your money. And if we don't like your answer, you're not getting it. Now, here's where it gets really important for you to understand the legal background behind what's happening. Under the Bank Secrecy Act and various federal regulations, banks are actually required to file what are called Suspicious Activity Reports, or SARs, when customers make large cash transactions. A large transaction, by the way, is anything over $10,000. And here's the kicker. Banks have quietly extended this surveillance to transactions that are way below that threshold. We're talking about withdrawals of $3,000, $5,000, even $1,500 in some reported cases, triggering internal red flags inside the bank's compliance system. What this means in plain English is that the bank is watching every single dollar you move, and they have given themselves the power to slow it down, question it, or stop it entirely, all while hiding behind the language of fraud prevention and federal compliance. But let's be very honest about what's really going on here. This is not just about fraud prevention. The banks are scared. The entire American banking system is sitting on a mountain of unrealized losses, primarily from commercial real estate loans and long-duration treasury bonds that lost enormous value when interest rates spiked. The Federal Deposit Insurance Corporation, the FDIC, has been publishing data showing that American banks are collectively sitting on somewhere between $500 billion and $600 billion in unrealized losses. That number is so large it's hard to wrap your head around it, but here's what it means for you. If enough people try to take their money out of a bank at the same time, that bank could collapse. The banks know this. The federal regulators know this. And so quietly, without making any announcement, without holding any press conference, they are putting up invisible walls to slow down and control how quickly you can access your own money. And this is not some hypothetical future problem. Remember what happened in March of 2023? Silicon Valley Bank collapsed in less than 48 hours, and then Signature Bank fell, and then First Republic Bank. Three of the biggest bank failures in American history happened within weeks of each other. The FDIC stepped in, the federal government made emergency promises, and the panic was temporarily contained. But the underlying problems that caused those banks to fail, those problems did not go away. They were patched over. They were band-aided. And right now, those same cracks are spreading through a much larger number of smaller and mid-sized regional banks across the country, banks that most Americans have their savings and checking accounts in, banks that your grandparents trusted, banks that your parents told you were completely safe. So, what are these banks actually doing when you walk in and ask for your money? Let's walk through exactly what happens. If you go to your local branch and ask to withdraw, say, $10,000 in cash, the teller is trained to ask you a series of questions. What is the purpose of this withdrawal? Where will you be keeping the cash? Are you aware of the risks of carrying large amounts of cash? This sounds polite. It sounds like they're looking out for you. But here's the truth. That teller is not your friend in that moment. That teller is filling out paperwork that gets submitted to a federal database. Your name, your account number, the amount you tried to withdraw, the reason you gave, all of it goes into a system that flags your account for future monitoring. And the next time you try to make a large transaction, that flag is already there. But it gets worse. Some banks are now requiring advance notice for large cash withdrawals. They're telling customers that if you want to take out more than a certain amount, you need to call ahead, sometimes 24 hours, sometimes 48 hours. That means there is a mandatory waiting period between when you decide you want your money and when you're allowed to have it. Think about why that would matter. If you hear some piece of news that scares you about your bank, if you learn that your bank has a problem, if you want to move your money to somewhere safer, by the time you've waited 48 hours, that window may have already closed. This is by design. They are slowing you down just enough so that a bank run never gets the chance to gain real momentum. And then there are the stories that are even more alarming. There are documented cases of banks actually closing accounts, closing them permanently, when customers ask too many questions or try to move money out too quickly. One woman in Texas reported that after she moved her money to a different bank for safety reasons, her original bank closed all of her remaining accounts and sent her a letter saying they were ending their relationship with her. No explanation, no appeal process, just goodbye. Another family in Florida tried to withdraw their cash savings in the weeks after the 2023 bank collapse scares and was told that their branch simply didn't have enough cash on hand to fulfill the request. Their branch, a major national bank with billions of dollars on its balance sheet, didn't have the cash in the vault. That should terrify you. That should make your stomach drop. Because what that means is that the money you see on your screen when you log into your online banking app is not physically sitting somewhere waiting for you. It's a number. It's a digital promise. And promises can be broken. Now let's talk about something called bail-in policies, because this is where most people's eyes glaze over and then they change the channel and then they lose everything. Please stay with me here because this is the most important part of what you need to understand. In 2010, after the financial crisis, governments around the world, including the United States, began quietly developing a framework called bail-in resolution. The idea was simple and terrifying at the same time. Instead of the government bailing out a failing bank with taxpayer money the way they did in 2008, a failing bank would instead be bailed in by using the money of its own depositors. What that means in simple terms is that if your bank fails, instead of the government stepping in to save the bank could legally reach into your savings account and convert your deposits into shares of the failing bank. Your cash becomes stock in a company that's going bankrupt. And yes, in the United States, this framework is absolutely real. It was built into the Dodd-Frank Wall Street Reform Act. Most Americans have never heard of it. Most Americans have no idea that this possibility even exists. But your bank knows about it, the federal regulators know about it, and now you know about it too. The FDIC insures deposits up to $250,000 per depositor per bank. Most people know that, but most people don't think about what that actually means when a large bank with millions of customers fails at the same time. The FDIC's Deposit Insurance Fund holds somewhere around $125 billion. The total amount of insured deposits in the American banking system is somewhere around $10 trillion. If you do that math, the FDIC has the cash to cover roughly 1.25% of all insured deposits. 1.25%. That means if there is ever a systemic crisis, a wave of bank failures happening simultaneously, the federal guarantee that most Americans believe is ironclad protection would almost immediately run dry. The government would have to step in with emergency funding, which means either printing more money or telling some depositors they have to wait. And in that kind of chaos, the people who acted early and moved their money to safety would be okay. The people who waited would not be. So what does this mean for you sitting at home right now watching this video? It means the window to act is not infinite. It means the time to think about diversifying where your money is sitting is not later. It's now. And I want to be very clear about something. I'm not telling you to panic. Panic is exactly what the banks and the federal government are counting on you not to do, because individual, calm, rational decisions made before a crisis are very different from the kind of mass panic that triggers the crisis in the first place. What I'm talking about is smart, strategic action taken while you still have full access and full control over your own money. Let's talk about what smart people are actually doing right now. Financial advisors and independent economists who are willing to tell the truth, the ones not on the payroll of the big banks or the big financial networks, are recommending a strategy of diversification that goes beyond just spreading money across different stocks or funds. They're talking about spreading money across different types of assets and different types of institutions. That means not keeping all of your savings at a single bank. It means looking at credit unions, which are member-owned and in many ways structurally safer than commercial banks. It means looking at treasury bills and treasury bonds held directly through treasurydirect.gov, which means your investment is held directly with the federal government and not through a bank intermediary that can restrict your access. It means thinking about physical assets like gold and silver not as a way to get rich, but as a way to hold a portion of your wealth in a form that cannot be frozen, cannot be digitally restricted, and cannot be made to disappear with a computer keystroke. And it means keeping a small but meaningful amount of physical cash in a secure location at home, not thousands and thousands of dollars, but enough to handle an emergency if electronic systems are unavailable for a period of days or weeks. Now, here's something else that most financial videos won't tell you. The banks themselves are not all equal. There is a massive difference in stability between the two big-to-fail megabanks like JP Morgan Chase and Bank of America, which the federal government has effectively promised will never be allowed to collapse, and the thousands of smaller community and regional banks that make up the vast majority of where ordinary Americans keep their money. The 2023 collapses were all regional banks. Silicon Valley Bank, Signature Bank, First Republic. These were not tiny operations. Silicon Valley Bank had over $200 billion in assets when it fell. If a bank that size can collapse in 48 hours, any bank can collapse in 48 hours. The question is whether you're positioned to weather it, or whether you're going to be standing in a line outside a closed branch wondering what happened to the money you worked your entire life to save. Let's also talk about what's happening in the bond market and why it connects directly to your bank account, because most people don't realize how tightly these two things are linked. When the Federal Reserve raised interest rates aggressively starting in 2022, it caused the value of existing bonds to fall sharply. Banks, which hold enormous amounts of bonds as core assets, suddenly found themselves sitting on massive paper losses. As long as they don't have to sell those bonds, those losses stay on paper. But if they're forced to sell, if depositors start pulling money out and the bank needs to raise cash, those paper losses become real losses. And real losses at the scale we're talking about, hundreds of billions of dollars across the system, can turn a manageable situation into a catastrophic one very, very quickly. This is the ticking clock that nobody in mainstream financial media wants to talk about seriously. The clock is still ticking. The interest rate environment has shifted, but the damage is still sitting on those balance sheets, and it is not going away on its own. You might be asking yourself at this point, if things are really this serious, why isn't this on the news every night? Why isn't CNN or Fox Business leading with this every evening? And the answer to that question is both simple and deeply uncomfortable. The major financial news networks are funded in large part by advertising from the very banks and financial institutions we're talking about. The message that everything is fine, that the banking system is stable, that you should leave your money where it is and stop worrying, that message is worth billions of dollars a year to the people who pay for those news programs. There is no incentive for the mainstream financial press to tell you the truth about the structural vulnerabilities in the banking system, because telling you the truth would frighten you, and frightening you would cause you to do exactly the thing that the banks most fear, which is taking your money out. So instead, they tell you everything is fine, and they keep telling you everything is fine right up until the moment when it's not fine anymore. And at that point, it's too late for the people who listened and waited. I want you to think about something for a moment. Think about the people who had money in Lehman Brothers accounts in September of 2008. The week before Lehman collapsed, mainstream financial media was still reporting that while things were difficult, the situation was manageable and contained. The week before. And then Lehman fell and the entire global financial system nearly collapsed with it. Think about the people who had deposits at Silicon Valley Bank on a Friday in March of 2023. On that Friday morning, there were still analysts on television saying the situation was being monitored and was not expected to escalate. By that afternoon, the bank was in the hands of federal regulators. 48 hours. That's how fast it can happen. That's how little warning you get. And that's why waiting to act until you're sure there's a problem means you've already waited too long. Here is the most important thing I want you to take away from everything you've heard today. The banking system, as it currently exists in the United States, is built on confidence. It is built on the belief that your money is there when you need it. The moment that confidence breaks, the moment a critical mass of people decide to test that belief at the same time, the entire structure becomes fragile in ways that no amount of federal insurance or government promise can fully address. The smart move, the responsible move, the move that protects your family and your future is to quietly and calmly reduce your exposure to that risk before the confidence breaks. Not in a panic, not all at once, but thoughtfully, strategically, and starting right now. Talk to an independent financial advisor, one who is not affiliated with a major bank or brokerage. Ask them directly about bail-in policies, about FDIC limits, about how to diversify outside of the traditional banking system. Look into Treasury Direct. Look into physical precious metals from reputable dealers. Think about your local credit union. And please have a real conversation with the people in your household about having some cash available in a secure place. These are not radical steps. These are the kinds of things that financially sophisticated people have been quietly doing for years. The difference is that now, the window of calm before potential chaos may be closing, and the urgency is real. If what you've heard today has made you think, if it's made you want to learn more or share this with someone you care about, please drop a comment below and tell me where your biggest concern is right now. Are you worried about a specific bank? Are you unsure about how much of your savings are actually FDIC insured? Are you trying to figure out how to start moving money without triggering a flag or a report? Whatever your question is, ask it below. I read every comment, and I do my best to respond to as many as I can. And please, share this video with someone who needs to hear it. Share it with your parents who have their life savings sitting in a single bank account. Share it with a friend who thinks the banking system is too big to fail. Share it with anyone who deserves to have this information before it's too late. Hit the share button right now. Send this to someone who matters to you. Because that's the whole reason we do this. Not to scare people, not to cause panic, but to make sure that when the storm hits, the people we care about are standing on solid ground, not caught off guard with nowhere to turn. Stay safe, stay informed, and we'll see you in the next one.